So now let's switch gears a bit, and let's talk about, instead of equilibrium arguments for asset pricing, let's talk about arbitrage arguments, and specifically the arbitrage pricing theory and how it relates to the campaign. So it's grounded on this principle of no arbitrage that we saw in our discussion of fixed income. The way that we could say, well, if you have a bunch of zero coupon bonds, you can essentially reconstruct the cash flows of a coupon-bearing bond, and the price of those zero coupon bonds that give you the same cash flows as a coupon-bearing bond had better be the same as the price of that coupon-bearing bond, because otherwise you could essentially create an arbitrage trade by selling the cheaper one, or sorry, buying the cheaper one, selling the more expensive one, and therefore actually face zero risk because you've essentially already offset all future cash flows, making some positive money up front. We can extend this beyond fixed income to really any trade in risk assets by again saying that a riskless arbitrage, and all arbitrage, to be arbitrage, must be riskless. Arbitrage exists if you can create this type of portfolio that has zero cost now, and gives you a certain profit in the future, or alternatively, a certain profit right now and zero losses or zero other different cash flows in the future, as we did with fixed income. In other words, essentially a free money machine. You take no risk, you put up no money, but you get certain profits. So how do you actually go about doing this? How do you construct a zero-cost portfolio that has zero risk, but a certain payoff either now or in the future? Well, you of course need to have zero cost. You need to buy something and you need to sell something else, such that the cash earned from the selling in whatever trade you've proposed directly offsets the cash spent on buying whatever it is that you proposed in this trade. This would be a arbitrage portfolio. So you short a certain number of securities, you get a positive cash flow out of that. You use the proceeds to buy some other securities such that your net cost is either zero, and then you get a payoff with certainty in the future, or your payoff is positive right now and you get zero cash in or out in the future. So arbitrage would be that sort of situation of zero investment now with sure profits. Now, how can we actually use this idea to price assets, though? I mean, this sounds nice in practice, and perhaps we can even spot some arbitrage opportunities every now and then. But how do we actually construct a theory of expected return and risk out of that? Well, what we do is we scale this idea up. We say that, all right, let's say that there is an arbitrage opportunity out there. Well, the zero investment property means that a lot of people are going to want to do it, or at least whoever does want to do it is going to want to do it a lot. Since you don't need to actually put up any money up front, you can take as much advantage of this as you possibly can. In fact, you will want to take an infinite position in this zero investment portfolio because you get risk-free profits. And what this means for markets is that the existence of a profitable arbitrage will actually be its undoing. In other words, if, let's say, the asset that you wanted to buy was undervalued and the asset you wanted to short was overvalued, by buying tremendous amounts of the undervalued asset, you push its price up, and by selling large amounts of the overvalued asset, you push its price down, which means that you will actually restore equilibrium prices. And that's sort of this nexus of how arbitrage pricing actually relates to equilibrium pricing that we talked about in the beginning of this set of discussions. These two are related, but that means that we can actually construct arguments about what the expected return or the price of an asset should be in terms of what it would be simply to rule out arbitrage trades. Because again, if there were an arbitrage trade, it would be undertaken to such a large extent as to adjust prices to their equilibrium levels to make that trade no longer possible. And a consequence of no arbitrage is this idea of the law of one price. In other words, if two assets are essentially economically equivalent in terms of their risk and return, they should have the same market price. And if they don't, if the law of one price is violated, then there actually are arbitrage opportunities. But if there are arbitrage opportunities, that means that arbitrageurs will bid up the price of the undervalued asset, bid down the price of the overvalued asset until the arbitrage opportunity is eliminated and the law of one price again holds. So that's sort of how we translate arbitrage arguments into actually arguments about what the appropriate price of assets would be. In other words, how we actually construct an asset pricing theory out of arbitrage arguments. Now, what does arbitrage pricing theory have to tell us about a well-diversified portfolio? Well, we sort of know this from our discussion of the single index model. We know that the return on a diversified portfolio should be the expected return plus the beta on whatever our macro factors are. If we have a single model, we just have a single beta and a single macro factor, but we could have a multiple macro risk factor model. And in fact, the arbitrage pricing theory generally presupposes that you will have multiple risk factors. You can think of this beta as sort of a vector of your exposures, potentially, and the F as the factor of, or the vector of macro factor payoffs. But let's think about this in single index model terms for now. Is just going to be the beta of the portfolio on whatever your one macro risk factor is, times the realization of that risk factor. And then, of course, there's going to be that idiosyncratic component of firm-specific risks of the firms in your portfolio that are not related to the macro risk factor. Well, the expected return to your portfolio is going to essentially be the weighted sum of the expected returns of the individual assets in the portfolio. The beta of the portfolio is going to be the weighted sum of the individual betas of the risk assets in the portfolio, where these WIs are the essentially proportions of the portfolio that you have in each of your individual risk assets. And your total portfolio firm-specific or idiosyncratic risk is going to be the weighted sum of the individual firm-specific idiosyncratic risk components, because again, remember, there's no, there's assumed to be no correlation or covariance between the firm-specific risks of any two firms, by virtue of them being firm-specific. And then given that argument that we've made about diversification, as we add more and more assets to our portfolio, we can actually mathematically show that the portfolio idiosyncratic risk goes to zero, because we can express the portfolio idiosyncratic risk as 1 over the number of securities times the average firm-specific risk, as we saw in our single index model discussion. And therefore, as you add more and more to securities to your portfolio, that 1 over n fraction becomes smaller and smaller. And that means that your firm-specific component of portfolio risk goes to zero as the number of securities increases, and therefore their weights decrease. So what does this mean for returns, essentially as they relate to the systematic risk factor? Well, for well-diversified portfolios that have no firm-specific risk component, again because of this idea that the firm-specific risk component will diminish as your portfolio becomes more and more well-diversified, and here it's important to note that we're talking about well-diversified portfolios. If we look at panel A, which would have them, essentially arbitrage pricing theory says that the expected returns of all portfolios that are well-diversified must fall on a line if we have a single systematic risk factor. In other words, the systematic risk factor exposure must be all that determines the excess returns to any well-diversified portfolio. The more exposure you have, the higher your excess return, and the lower exposure you have, the lower your excess return. But of course, this doesn't necessarily hold water for individual stocks, because individual stocks certainly have firm-specific risk components, so they'll fall somewhere off this line. You can sort of think of this as similar to that line that we drew between expected returns and beta, except now we've got expected returns and systematic factor exposure. But again, in CAPM world, your systematic risk factor is the market. Therefore, this could essentially be that same plot with betas. And indeed, this is sort of what you would expect for individual stocks. They would fall somewhere either above or below this line, depending on their firm-specific risk. But how do we ensure that all portfolios must actually lie on this line? In other words, why must their excess return definitely be determined solely by their exposure to the systematic risk factor? Well, let's think about one portfolio that actually lies off the line. Let's say that portfolio A has a certain exposure to our market factor, and it has an expected return of 10%. And portfolio B has the same exposure. In other words, the slope of its line is actually parallel to that of A, but it has a lower expected return. Well, that would be an arbitrage opportunity, right? If they have the same exposure to the macro risk factor, let's say, to be more precise, let's say they both have a beta of 1. The beta of A is equal to the beta of B. And those are both equal to 1. How could we construct an arbitrage trade to make infinite money on this, assuming these are well-diversified portfolios? Well, it's simple, right? You would go long A, and you go short B, this would be riskless because, remember, these are well-diversified portfolios, so they have no firm-specific risk. All they have is systematic risk, and the systematic risks are equal. So if you sell a share of B for every share of A you buy, that means that you have a beta of 1 minus 1 equals 0 of this total portfolio that is long 1 share of A for every share of B that it is short. That means it's a riskless portfolio. But since A offers you 2% more return, 10% versus the return that B offers you 10%, 8%, that means that the expected return to this long-short portfolio is going to be 10% for every share of A that you are long, minus 8% for every share of B that you are short, equals 2% for every share of this portfolio that you construct. And that is going to be a risk-free expected return, a arbitrage opportunity. Now, what does this mean for asset pricing? Well, again, that means that if somebody discovers this and they are well enough capitalized to start trading this, they're going to want to trade this as much as possible. They're going to keep trying to buy shares of portfolio A, which will put downward pressure on the prices of all of the assets in portfolio A. And they're going to try to keep selling, or sorry, if they're going to keep buying portfolio A, they're going to put upward pressure on the prices of the shares in portfolio A, but that means it'll put downward pressure on the returns of all of the shares in portfolio A, because as the price gets driven up, the expected return on those shares must get driven down. And they're going to put downward pressure on the prices of all of the assets in portfolio B, therefore putting upward pressure on the expected returns of those assets, because as the price gets driven down, well, that means that the expected return goes up. And it's going to keep happening until the expected return to A is equal to the expected return of B. In other words, when the expected return to this arbitrage portfolio, instead of being some positive number, actually goes to 0. Then the arbitrage opportunity stops existing. But then, of course, that means that equilibrium has been restored, because these two assets having the same level of macro priced risk and no other risk, because they're well diversified, now have actually achieved the same equilibrium price exactly by the action of arbitrageurs in eliminating this mispricing. Now, does this sort of thing work just for two portfolios that have the same beta? No, of course not. So let's think about two portfolios, again, in sort of expected return beta space. We'll call one portfolio A and another portfolio C. Now let's say that portfolio C has an expected return of 6%. Now let's also say that the beta of portfolio C is 0.5. The beta of portfolio A is 1, but portfolio A has an expected return of 10%, and the risk-free rate is 4%. Well, what is the arbitrage trade here? You can sort of view it graphically here. What is point D? Well, point D is essentially a 50-50 weighting of portfolio A and the risk-free asset. Those two combined together in 50-50 proportions will give you portfolio D. And what is the expected return to portfolio D? Well, it's 50% of the expected return to asset A, 50% of the expected return to the risk-free asset. In other words, 5% from A, 2% from the risk-free asset. In other words, 7%. And what is its beta? Well, the beta on the macro factor for the risk-free asset is, of course, 0. And the beta on the macro factor for portfolio A is 1, but the portfolio that has half of A and half of the risk-free asset, remember, has a beta that's essentially going to be half of the beta of portfolio A plus 1/2 of the beta of portfolio RF, the risk-free asset. The beta of the risk-free asset is 0. The beta of A is 1, and therefore the beta of the portfolio that has half of its weight in portfolio A is going to be half of that beta, or 1/2 of 1 equals 1/2. Then the arbitrage opportunity becomes quite clear, right? We've constructed a portfolio D that has the same beta as portfolio C, but a higher expected return. So now we're back to that same setting that we were discussing in the prior set of slides. We can again go long the higher expected return portfolio D. We can go short the lower expected return portfolio C. And if we go 1-for-1 on this, we eliminate all of our systematic risk. And since these are diversified portfolios, there is no firm-specific risk, so there is no more risk at all. So the beta of this portfolio is going to be 0, because our long beta is 0.5, our short beta is 0.5, our net beta is 0. But our expected return is going to be, well, for every share that we buy of D, we get 7%. For every share of C that we sell, we have to give up 6%. That means that our expected return is 1%. And this profit is again going to be risk-free because we have eliminated all systematic risk and there is no idiosyncratic risk. So what does this mean for asset pricing now? Well, again, the same idea. By actually uncovering this arbitrage opportunity and carrying this long-short trade on in large enough scales, buying up more and more of portfolio D, we're going to put downward pressure on the expected returns to portfolio D. So the return on D is going to fall, presumably because, well, the risk-free rate might not change, but the return on portfolio A, since for every share of D that we buy, we're effectively buying 1/2 of portfolio A. And I mean, if we're truly big, we might even affect the risk-free borrowing rate in the treasury auction. So we might actually affect the risk-free rate as well. We're going to push up the prices of the risk-free asset. We're going to push up the prices of all of the assets in portfolio A. We're going to push down their expected returns. For every share of C that we sell, we're going to push down the prices of all of those portfolios, and we're going to therefore push up the expected returns of all of the assets in portfolio C. And this is going to keep going until the expected returns to portfolio A and the risk-free rate have gone down enough such that the expected return to portfolio D is equal to the expected return to portfolio C, probably somewhere in the middle then. So when that return goes to 0 instead of 1%, then the arbitrage trade will of course cease to exist, but by virtue of it having gone on, it will have restored the prices of all of the assets in portfolios A, C, and the risk-free rate to equilibrium, such that their payoffs are actually mutually consistent.